Now let's come to the biggest story this week. The US Federal Reserve will begin a two-day meeting tomorrow where it will decide whether to raise interest rates or not. That rate has been held near zero since the global financial crisis in 2008. Investors and analysts expect a modest increase of 0.25 percentage points, and Fed Chief Janet Yellen has said that any increase would only be gradual. Usually low interest rates have helped lift stock prices over the years since the Federal Reserve has been careful about not upsetting a fragile economic recovery. And for more on that impending US rate decision and its implications, I'm now joined by Kathy Bostjancic, head of US Macro Investor Services at Oxford Economics in New York. Hi, Kathy, and thank you very much for taking your time out to be here with us on the big picture. Several analysts have said that as and when this rate hike happens, it will come with a fair amount of turbulence. Do you feel that the markets have priced in the possibility of a rate hike? And what sort of possible turbulence do you foresee if that happens?
Yeah, thank you for having me on your show. I think for the hike, the liftoff this week, it has been essentially priced into the market. So it won't be a surprise. In fact, it would be a surprise if the Fed didn't engineer interest rate liftoff. And I would say, looking at market prices for 2016, the market's also priced in our estimate of what the Federal Reserve will do. We expect just 2 rate hikes in 2016, and that's essentially priced into the market. Beyond that, though, the markets are looking for a much shallower rate profile than we expect, and certainly much less than what the Federal Reserve's dot plot estimates show.
Right. In fact, that's a fair point. As you said, that it will be a surprise if she does not go ahead and make that rate hike announcement, because many say, that if she doesn't do it, I mean, more than the surprise, it wouldn't sort of augur well in terms of how the U.S. economy looks. I mean, if she refrains from going in for a rate hike, it would mean that the fundamental problems in U.S. economy have not been resolved. So from that perspective, it's almost a given that she will go ahead and make that rate hike, howsoever small the rate hike may be.
That's right. I agree with you. I think not raising rates would be a big lack of confidence vote, which would unnerve the markets even more than they seem to be at the moment. And so really it's essentially a done deal. I think the question becomes, how do they communicate about the future path of interest rates? So the real emphasis and shift towards that future path is what's most important. And we'll read the Fed's policy statement. We'll see the dot plot estimates. They'll update those. We'll see the updated macroeconomic forecast. But most importantly, we'll hear from FOMC Chair Yellen in the news conference. That, I think, is going to be the most important for the market to digest.
Right. But how do you respond also, to the other argument, saying that the U.S. economic recovery is still very fragile, and any rate hike, could sort of derail that story? In fact, even the IMF had urged the Fed to go very slow, when it comes to their rate hikes.
Well, I think there's still great uncertainty about the impact of the rate liftoff. That's a fair point. They've been at the zero interest rate level for 7 years now. So the fact is there's a great amount of uncertainty. Even raising rates 25 basis points could have some unintended impact. And of course, right now we're in the context of the high yield market having all types of trouble and concern it could spread. But I think what will happen is they'll be very gradual, and kind of how we look at it is she'll be dipping her toe into the water, and I shouldn't say her, but the FOMC in general, and seeing what the ripple effect will be. So it's sort of go and then step back and wait and see. We think it'll be probably a good 6 months before they tighten again.
Right, absolutely. In fact, I just want to sort of, stay with that point and the possible spillover impact of that rate hike, because many are also wondering its impact on the housing market, because already, the default rates on housing loans is very high, and this will only increase the mortgages. It's going to push up the mortgages even more so, and housing being a key sort of yardstick or an indicator of economic recovery, there will be short-term pain. That is unavoidable.
Well, I think there it depends on really what happens with 10-year yields. The U.S. 10-year Treasury yield is really the benchmark for the 30-year fixed mortgage rate, which is what is most prevalent in the U.S. There are some adjustable rate mortgages, but a lot less than what we saw in 2005 and 2006 during the housing bubble. So right now, actually, we're seeing 10-year yields come down a bit lower. And that's part of the foreign capital flows from abroad because the ECB is engaging in continued quantitative easing, but also because of a flight to quality, because when there's concern about a certain asset class like high yield, you see a flight to quality treasuries. But I do agree, as time goes on, and assuming that some of the turmoil in the market settles down, the Fed will be very careful about how high and quickly they calibrate interest rates higher. They certainly would not want to choke off the housing recovery, which is just really starting to get going in a meaningful way.
Right. So then, what's your sense then? Do you think that the U.S. economic recovery is strong enough to absorb, let's say, a 0.25 percentage point hike in rates?
We think that a quarter point in December would be fine and digestible for the economy. And we see underlying momentum in the labor market, income, even though wages have been slow to respond. And also consumer spending still remains a very strong propeller of the U.S. economy. And lower oil prices do benefit the consumer. But we think, going forward, we would see a below consensus rate profile. Again, just looking for another 50 basis points next year. It's because that the economy, it's not so much it's fragile, but that the growth rate is just not as robust to really accommodate and be in line with higher rates.
Right. But do you think overall, if we were to reflect back, and if Janet Yellen does indeed go out there, and day after tomorrow she does hike the interest rates, do you think, sort of reflecting over this period where interest rates were almost at, near 0%, it served its desired purpose?
So I think that, Yellen, and particularly, leading the Fed, I think that the biggest onus on her, if I understood your question correctly, the biggest onus on her is communication.
Right.
Some people are labeling this a dovish rate hike because they're going to really be very clear that they want to go gradually and slowly. They don't want to unnerve the markets. Of course, the risk on the other side is they're so dovish that has other unintended consequences for the market, right? If you remember Greenspan, he said they would raise rates in a very measured way, and in fact, they did, but they went very predictably 17 consecutive 25 basis point rate hikes. That's something the Fed wants to avoid.
Right. Thank you so much, Kathy. We'll leave it at that. Thanks so much for taking our time and joining us here on the CNBC TV 18 Big Picture. Thanks very much.